Howdy, folks. Welcome to Liberty Call for Thursday, February 17th, 2022. I'm Raymond Dahlman, your humble host. If it's your first time watching, please click on that subscribe button. It's probably right about there. And also share with friends and family. I greatly appreciate it. Hope everybody's having a fantastic day out there. It's a beautiful day here in Colorado. The sun's out. The storm moved through fairly quickly, and we didn't get pummeled with too much snow. So I got the driveway cleared and got the salt out on the sidewalk, cleared off the cars. So had a busy day in addition to going through 1099s for people and sending the same repetitive email over and over again. So that's a lot of fun. So if you haven't gotten an email from me about 1099s, they're on the way. It's a slow process going through and organizing everything. So, and then over the next couple of days, I'll be going and looking for any missing cost basis data. Now, if you see something that I don't see, feel free to shoot me an email. I'll be happy to jump on that ad hoc as needed. All right, well, let's take a look and see how the markets did today. It was pretty ugly in the stock markets. The Dow Jones was down 1.78%, closing at 34,312. S&P 500 was down 2.12%, closing at 4380. NASDAQ was down almost 3%, down 2.88%, closing at 13,716. Small caps are down 2.65. The VIX was up 15.73% today, closing at 2811. So that's pretty high. Let's look at, everything was red all across Europe until, the first green sign I see is Budapest, Hungary. They were up almost 1%. Then more red until we get to the Asian markets. What is this? Australia, New Zealand. Australia was up. New Zealand was flat. The Chinese markets were all up for the day, and then when you get into some of the smaller ones in Asia, they were down. So I would say, starting at last night in the Asian markets, things were pretty good. Nothing huge, anywhere from slightly up to maybe about 0.5%. But then once we got into Eastern Europe, nothing but down. And like I said, the everything here domestically was down from the way it looks. So pretty ugly from a market perspective today. The last 2 days had been a little bit better. Hey, it's just the situation we're in right now with, the volatility, the inflation situation. What is the Fed going to do over the next, the rest of this year? Are they going to stick to their guns and raise the interest rates like they should, or are they going to be spineless cowards and lower interest rates back down to zero, the first little bump that we might run into? So I don't know. I personally would bet on them being spineless cowards, since they're the ones who got us into this disaster. You cannot create, 25, 30, 35% of new money over the course of a year or two and expect it not to have huge tsunami ripple effects throughout the economy. So, but hey, people a lot smarter than me who work there obviously know what they're doing. Yeah, we'll see. All right, well, let's take a look at, I got 4 articles here I want to review. First one comes from Barron's. The Dow is falling because Russia fears are back. And what else happened in the stock market today, written by Jacob Sonnenschein and Jack Denton. Stock market cratered Thursday on reports that Russia continues to build up troops on the Ukraine border. The Dow Jones Industrial Average, we already covered all those. Wall Street is feeling very jittery as it looks to the left and sees intensifying geopolitical risks with the Ukraine situation, and then it looks to the right and sees the potential for aggressive Fed tightening, wrote Edward Moya, senior market analyst at Owanda. Ukrainian authorities said there have been ceasefire violations, while U.S. and European officials said that Russia has continued to build up its troops along the Ukrainian border. Other reports said U.S. and Russian military aircraft flew dangerously close to each other. Secretary of State Anthony Blinken told United Nations Security Council that Russia could invade Ukraine in the next few days. Oh my God, it's going to be a war. I don't think so. The big worry for the U.S. investors is over supply of oil. Russia is one of the world's largest producers, and sanctions or other restrictions on supply could cause the price of the commodity to surge. Thursday, WTI fell 2% or just below $92 a barrel, though it's still up 2% in the past week. One factor potentially weighing on oil prices and offsetting upward pressure related to the Russia issue is higher inventories. U.S. Energy Information Administration reported for the week ending February 11th, released Wednesday, showed that U.S. Crude inventories rose about 0.3% to 411.5 million barrels. Federal Reserve's monetary policy isn't helping. The Fed is expected to lift interest rates several times to deal with high inflation. We know that, which would only worsen if oil prices surge. While the minutes from the Fed's January meeting released Wednesday, we already covered all that. Comments from St. Louis Fed President James Bullard Thursday added to concerns that the Fed will raise interest rates more times than currently expected. Bullard said in the speech that the central bank should pursue the best monetary policy it can and that markets will make their adjustments appropriately. He also said that an appropriate benchmark lending rate would be 1% by July 1st. That would imply 4/4 percentage point moves by then, the amount markets have been pricing in for the entire year. A full-blown military conflict with Russia combined with Fed policy plans would put a dent into expectations for economic growth. A worsening Russia situation would push oil prices up and make inflation worse and more sticky, said Tom Assay, founder of Seven Reports Research. The Fed would have to react to that. We're out of the period where the Fed can dismiss things because they're more temporary. Result has been a move into haven assets where investors can ride out stock market volatility. The price of the 10-year note or treasury notes rose, sending the yield down to 1.96% from a touch over 2% at Wednesday's close. Excuse me. The Russia-Ukraine de-escalation cycle continues, bringing a bid for haven assets back this morning, wrote Dennis Debouchier, founder of 22V Research. Elsewhere, weekly initial jobless claims rose to 248,000 from 225,000, above estimates for 219,000. Overseas, let's see, Bitcoin. Yeah, the most of this is just specific data. So, looking at it, is the war on? Is the war off? I don't think this is a problem we need to be dealing with here in the United States. Ukraine is not a NATO country, and frankly, we gave many promises throughout the 90s that we would not expand NATO onto Russia's doorstep, and to do so is a breach of that, handshake agreement. I know there was, nothing in writing, but you know what? When you tell someone you're not going to do something, or you are going to do something, you actually stick to it. So that's just my view. All right. Next article, Wall Street banks fear inflation, asset price deflation, and even a recession. This is written by Matt Schaufman, Noor Zanib Hussein, and Elizabeth Dilts Marshall from Reuters. Wall Street's biggest banks sounded a warning all over the year ahead on Thursday, citing high inflation, credit concerns, asset price depreciation, and companies postponing deals due to market uncertainty. U.S. banks reported a mixed bag of fourth quarter earnings last month as trading revenue fell at the Federal Reserve scaled back its asset purchases. They are now grappling with high inflation and the likelihood of multiple rate hikes. Several top executives commented on market conditions at Credit Suisse Financial Services Forum in Florida. Bank of America is concerned enough about inflation to stress test its portfolio for the possibility that Fed policymakers are unable to control it and prevent the country going into recession. Chief Executive Brian Moynihan said, "We have to run these scenarios," he said, that what will hurt the industry generally will be if they have to create a recession, and that's not their goal for sure. They'll hopefully do a great job handling it. We stress test that, and we're fine. Do you actually think the Fed is actually going to do anything well? I mean, come on. It's not a government agency. It's privately held, but it's in cahoots with the government, which doesn't do anything well or cheap. Goldman Sachs chief executive David Solomon warned that rampant inflation could be a headwind to growth. We're moving from an environment of very easy money and below trend inflation to an environment of tighter money and above trend inflation. The economic environment is different, and there will be consequences to that, he said. Solomon added that everybody is used to asset appreciation, and we might have a period of time where there's less asset appreciation, meaning things are either going to be flat or down for a while. Mike Massimo, the Amazon guy's here, chief financial officer at Wells Fargo and Co., the fourth largest U.S. bank, noted that credit spreads had been widening and that it's an area to watch to see if there's any cracks that start to emerge. High inflation and expectations of more aggressive rate hikes from the Fed have whipsawed markets this year, sending the S&P 500 down 7% year to date, while bond yields have jumped and the yield curve is flattened. Bank shares declined Thursday with the S&P 500. We know it's down. Morgan Stanley chief financial officer Sharon Yashaya said the bank had seen a lot of uncertainty in the marketplace over the past couple of weeks, leading to the companies putting off transactions. We've seen some of the pipelines, which are still healthy, being pushed out, she said. At this point, it doesn't feel like the first quarter of 2022 is going to be the same as the first quarter of 2021. Trading and investment banking activity has slowed since 2021, but was still healthy, Solomon said. Bank of America's Moynihan took a similar tone, saying that the bank's capital markets business is down so far in 2022, even though it continues to see a strong pipeline of customer activity. Wells Santo Massimo noted that while the bank's consumer and real estate portfolios continue to perform, there has been a little bit of noise in auto loans. Not sure what that's supposed to mean. Does that mean defaults? However, he said that rising rates would help the bank's ultimate goal to reach a 15% return on tangible equity. When interest rates are higher, banks have more money by taking advantage of the difference between interest banks pay to customers and the interest they can earn by investing. That's called a spread. The question will be where rates go and what impact that has on the economy and the environment we're in, Santa Massimo said. So, sounds like the bankers are starting to get a little bit worried. So, they've been putting on a brave face the last, 2 years. Oh, everything's fine. Nothing to worry about. We'll just print some more money. I don't know how that could be a problem. Oh, your groceries are more expensive? Oh, sorry. But we here at the bank are fine. So, yeah. All right. Next article, U.S. labor market still tightening. Freezing temperatures chill home building. It's written by Lucia Mutikani from Reuters. The number of Americans filling new claims for jobless benefits unexpectedly rose last week, but remained below pre-pandemic levels. Pardon me, it's a spam call. Bye-bye. Unexpectedly rose last week, but remained below pre-pandemic levels as labor market conditions continue to tighten. The first increase in a month reported by the Labor Department on Thursday did not change economists' expectations for another month of solid employment gains in February. This is an acute shortage of workers, which has seen employers boosting wages and offering other incentives to retain their workforce as well as attract labor. Economists blame the rise in claims on week-to-week volatility in data and harsh weather in some parts of the country. Given the regular noise in the data and range of factors that can impact filings, we don't think the recent jump in initial claims filings is particularly worrisome at this point, said Daniel Silver, an economist at JP Morgan. Overall, we think the labor market remains tight. Initial claims for state employment benefits increased 23,000 to a seasonally adjusted 248,000 for the week ending February 12th. Economists polled by Reuters had forecasted 219,000 applications for last week. Unadjusted claims climbed 7,742 to 238,482 last week, lifted by big increases in Missouri, Ohio, Kentucky, and which offset notable declines in Pennsylvania, New Jersey, and Wisconsin. Claims had also been declining since hitting a 3-month high in mid-January as coronavirus cases fueled by Omicron variant raged across the country. Infections have dropped significantly in recent weeks. Again, I don't understand what Omicron has to do with unemployment, because you don't file for unemployment because you're out sick for a week. I don't understand why these article or journalists continue to harp on that. I haven't seen any data that that's the case. So, anyways, off my soapbox. There were a near record 10.9 million job openings at the end of December. Claims have plunged from an all-time high of 6.194 million, or 1. 6.149 million in early April of 2020. Last week's data covered the period during which the government surveyed business establishments for non-farm payroll. Portion of February's employment report claims are well below their 290,000 level in mid-January. The economy created 467,000 jobs in January. Stocks on Wall Street slumped amid escalating tensions between Russia and Ukraine. The dollar rose against the basket of currencies. U.S. Treasury yields fell. Maximum. Let's see here. Let's get down to the part about freezing temperatures. All right. Freezing temperatures depressed home building in January. A third report from the Commerce Department showed housing starts dropped 4.1% to a seasonally adjusted annual rate of 1.638 million units last month. Temperatures were well below average from the Midwest and Tennessee Valley to the Northeast in January, according to the National Center for Environmental Information. So much for that global warming. Single-family housing starts, which account for the biggest share of home building, tumbled 5.6% to a rate of 1.116 million. Starts fell in the Northeast, Midwest, and South, but rose in the West. Last month's decline is, however, probably temporary, as building permits rose 0.7 to a rate of 1.899 million units, the highest since May of 2006. Single-family permits surged 6.8% to a rate of 1.205 million units, a one-year high. The supply of previously owned homes on the market is at record lows, but builders are facing challenges from soaring prices for inputs. Prices for softwood lumber, which is used for framing, shot up 25.4% in January. A government data showed this week. That's not good. The National Association of Home Builders said Wednesday that building material production bottlenecks were delaying projects, noting that many builders are waiting months to receive cabinets, garage doors, countertops, and appliances. The supply squeeze was underscored by a surge in the backlog of houses approved for construction, but not yet started, to a record last month. Rising mortgage rates could also slow demand for housing, especially among first-time buyers. The 30-year fixed mortgage rate jumped above 4% last week for the first time since 2019, according to the Mortgage Bankers Association. Quote, rising mortgage rates pose a significant risk to housing demand, but it's unclear what type of lag would exist for this impact to appear in the construction data, said Isfar Munir, an economist at Citigroup. New homes can be sold before they are started, and last bid attempts to buy homes before mortgage rates increase further could boost new home sales before the Fed actually begins hiking. This would be a positive tailwind for housing starts, at least for a few months. So, I mean, yes, it's colder in, anywhere north of Dallas. So, I mean, I've had, it snowed probably once or twice a week since the last week of December here. And I've got a snowbank in front of my house that is at least 12 inches deep of compacted snow, just because it doesn't ever get any sunlights, and it will be there probably until April or May, just because it just never gets any sun. So it just doesn't ever warms up there. So, anyways, so it is understandable that there's going to be a slowdown in housing and housing starts at this time of the year, just because it's harder to work when it's, the weather's bad, and then you pile on top of that, we're still having some, slowdowns with supply chains. So again, it's not totally shocking. All right, last article here. This is kind of an FYI article. Unemployed workers could get a nasty surprise at tax time, written by Gabriela Cruz Martinez. And this comes from Yahoo Finance. All right. If you're one of the 25 million, if you are one of the 25 million of workers who collected unemployment in 2021, you owe income taxes on all those benefits this tax season, unlike last year. Jobless benefits are generally counted as taxable income that taxpayers must report to the IRS. Those include any of the special unemployment compensation programs passed by Congress during the pandemic, as well as regular unemployment insurance. Question I have: why are we paying taxes on money that was already taxed? It was kind of the biggest question when I was a government employee, when I was serving in the Navy. It's like, we're using taxed money from the private sector to pay all the government's bills. So why am I now paying taxes on that expense, which is my income, back when I was a sailor? So I never understood that. It's like all the people who work for, like where I grew up, NASA and all the government contractors and employees around the country. First of all, why are they paying taxes? Because they're just sending it back to the treasury. It's not like it's money from the private sector that's adding to the tax pool. It's just a reduction in their pay. So I mean, if all the money that was collected in 2021 is paying the incomes of government employees in 2022, it's just a surplus back for the previous year. So again, I don't get it. Let's see here. This may come as a surprise to workers who got tax relief for the first $10,200 of unemployment income they received in 2020. A one-year break provided by the American Rescue Plan, especially since the change this year could shrink their tax refund. Beyond just people getting unemployment, the amount of unemployed people have gotten and how much they relied on it last year was multiples higher than usual. So many people had 20 or 30,000 in unemployment that it was just normal for last year. Russ Garofalo, founder of Brass Taxes, told Yahoo Money. These same individuals got a tax break on their first $10,200. That was a big benefit to folks. That's no longer available. It feels particularly unjust that you paid into the system, needed help, and when you needed help, they want to cut. Just what I said. They want to cut you out of your help, said Garofalo. Let's see. Unemployment benefits are taxed like ordinary wages, but are not subject to Medicare or Social Security taxes. If you received unemployment compensation last year, you should receive a Form 1099-G from your state. This document will show the amount you were paid and the sum of federal taxes withheld, if any. This is where it could get tricky, said Garofalo. Since the onset of the pandemic, some states, such as California, did not apply a 10% tax withholding on certain unemployment benefits. This means that taxpayers who didn't withhold could get a smaller tax refund than expected, or none at all, because they could owe more than their refund. We had a lot of people owing a little bit and getting a small bit of a refund from the IRS if they had withheld taxes from their unemployment, but owing the state often a considerable amount of money, Garofalo said, because the state of New York only withholds a very low percentage rate and the city doesn't withhold at all. We had quite a few people, somewhere around a couple hundred. We had quite a few people somewhere around a couple $100 back from the. Wow, we had quite a few people owe somewhere around a couple $100 back from the government and owing $2,000 to the state and the city of New York. Gosh, you might want to proofread that one. To avoid this, the IRS recommends setting aside money to cover unemployment taxes. Typically, you can choose to have up to 10% of each payment withheld from your unemployment benefits for the federal taxes with your state or unemployment office. Recipients who didn't choose voluntary withholding or didn't withhold enough can opt to make quarterly estimated payments to the IRS. How nice! I bet they'll charge you some interest on that. The circumstances when you receive unemployment, you are not in the best state of mind for deciding if you're going to set aside money, some of this money for taxes. Garofalo said it can be hard to make that choice when you need that money now. But when you have to deal with it, it can be quite a significant tax bill if you end up getting anywhere between $10,000 and $30,000 in unemployment. If you can't make a lump sum on your tax bill, don't put it on a credit card. According to Garofalo, the best practice is to start paying off your state debt first, as these carry higher interest rates than the federal government. Depending upon the year, your federal debt can have an interest rate ranging from 3 to 5%, which is often lower than state interest rates. For the federal government debt, I like to tell people to see it as a nice credit card with a low interest rate. They'll give you up to 6 years to pay off your taxes as long as you don't ignore them for a long time. They won't do anything. Garofalo said they won't do anything. They'll just want to get paid, and they are very understaffed, so they don't want to chase you around. I personally would say everyone stop paying your federal taxes. The government will collapse within 90 days, and then we won't have to pay taxes ever again, or at least to the behemoth government, which steals a quarter of the productivity out of the economy every year. All right. That's everything I had for today. I hope everyone got something from this. If not, I don't care. I'm just here to ramble. So if anyone needs anything from me, don't hesitate to shoot me an email or drop me a phone call. And I'll be back tomorrow with the weekly wrap up. And hopefully we have a better day in the market than we did today. But, with all the volatility going on, I'm not going to hold my breath, because I'm definitely not a Democrat mayor or governor in California taking a picture with Magic Johnson. Anyways. All right. Well, I hope everyone has a great night, and I will be back tomorrow.